Good afternoon. My name is Don Vivrette, and we're going to start the session. Actually, you're going to want to go away in a moment, Patrick. I'm going to go through a series of slides, and then when I finish those, then we're going to come back and Patrick and Pete will join us. And so let me get back to that. I want. So what we're going to do is go through at the moment in terms of where all we are and what's going on. Welcome to It's Your Money virtual program. This is the second week that we are going through and doing this. What I want to do is remind you that you've registered for one or both of the sessions. You got a confirmation. You should have received that obviously an hour ago perhaps, and then yesterday you would have received it. Those will come out. It does remind you to get the handout material, and that is on its materials at It's Your Money and It's Your Estate. I'll show that to you again in just a moment. You cannot turn on your audio or your video in a webinar, in these webinars. You can ask questions by using the Q&A. There's a button at the bottom, about in the middle of your screen. In a little bit, if you tap on your screen or move your mouse, you'll probably have that pop up. The visuals sometimes cover that up. So you'll be able to go through and do question and answers. I will either respond to you or I will ask the presenters the information as we go along. Sessions are recorded. They'll be available. I'll show you in a moment. They're actually already there from last week. And you can also get the same link as the handout material. Let me go back over here. So that's the website, materials at itsyourmoneyandestate.org. You'll come in here. If you click on the week, so in week 1, as an example, we already have the video up. The handout material is the presentation material, so that's what was available from last week, and a series of articles. But as soon as the webinar, as soon as the video is available, it will show up there and be available to you to go forward. We'd had a question asked last week in terms of how to find out information about the sponsors. On that same website, I added this one in because if you look up towards the right side, it says sponsors. And if you click on that, you get a series of the icons of the various charities that are involved. If you click on those, it generally will take you to their website and you can see that. Depending on what machine you're on, if you're on a PC, if you're on something like that, there's a bar, this little bar here between the picture and me, especially if you're in a speaker mode. You can move that left to right and it will enlarge or shrink it. You'll also be able to see the question and answer button that comes up. That will let you click. If you click on that, it pops up a box and you can enter in questions that you have. And as I said, I will ask those of our presenters or answer them if I have it easily enough for you myself. Here's the schedule. We're doing annuities and mutual funds today. Then we move more into the specifics of financial planning and other things. If you're with us tomorrow, we will be doing estate planning basics. And that's how we will go through that one. These are the organizations that we normally, or when we physically do these are the places that we normally go to. These are the charities that have sponsored us, participated with us over the years. Give a shout out to Chapman University for 10 years that they have been with us. And what we're also doing now, and we're starting it this week and we will be going all the way through, is we're bringing up one of the charities and having them present a 3 to 5 minute video. It used to be they would walk in and be a part of the presentation, but in this case, they aren't doing that because we're virtual. So Pete's going to turn on his microphone and or camera. Pete.
Hey.
Pete. Hello, Pete.
I'm right at Crystal Cove.
So what do you want to say about our sponsoring organizations?
I would like to say that, first of all, thank you for our sponsoring organizations to make this all possible. Most times when you have a financial or educational a program on money, they're sponsored by either a brokerage firm or a bank, and they're trying to sell you something. And so we included an article in the packet on the materials online on that it's good to give. And I see that over the many years that people who do give are happier, live longer, and we encourage you to give to 1 to 3 organizations that you are passionate about and that you have similar values of. And it's a great way to include them in your will or a trust, and it doesn't cost you anything today. And they also are part of us in the sense that they communicate to their donors the program here. So besides being that it's good to give, we allow each charity who is a sponsor to usually when we had the live sessions to come in and have people ask questions of them, give us a 3 to 5 minute spiel as to what their mission is. And so today we have the Newport Beach Library Foundation, and Meg is going to give us a little bit of the mission, what the Newport Beach Library Foundation does and how they do it.
And just as a note, incidentally, since we're recording all of this, this will be a part of the recording. So if you're going, wait, I need that phone number, or I need that website, it will be in the video. So you can easily go back to our site and pick that up. But let me show you Meg's note.
Hello, everyone out there in internet land. My name is Meg Linton, and I'm the CEO of the Newport Beach Public Library Foundation.
Stop, Meg.
Which is an
Stop, Meg. Let's change that. Let's see if I can find Meg. There's Meg. There.
independent 501c3 charitable organization dedicated to supporting the Newport Beach Public Library and its 4 branches: Central, Corona del Mar, Balboa, and Mariners. Annually, this library services over 1 million children, teens, adults, and seniors from across the county. The Newport Beach Public Library Foundation's mission is twofold. First, we fund valuable analog and digital resources in the form of books, DVDs, newspapers, licenses for online databases, ebooks, magazines, and web streaming services. We help purchase computer equipment and furniture and create things like the Media Lab and other capital improvements or projects like the proposed lecture hall. In addition to providing financial resources for tangible items, we also produce cultural and educational programming for the library in the form of lectures, workshops, conversations, youth writing contests, and many, many other types of events. Most notable are the annual witty lectures featuring top thinkers and writers of the day, like Doris Kearns Goodwin, Tom Brokaw, Sherman Alexie, and many, many, many others. Our community of Library Foundation donors have contributed nearly $7 million of materials and programs to and for the Newport Beach Public Library over the last decade. Providing free access to knowledge for all is not without considerable costs, especially during these trying times. Keeping a library modern and relevant requires financial resources, and government funding only goes so far. It's the incredible generosity of individuals who fund the rest and fill in the gaps through the purchase of an annual foundation membership, through the sponsorship of a program, through donations of cash or stock to our general fund, and generous legacy gifts from family estates and trusts. Award-winning author of the library books, Susan Orlean, has said, "The library is a gathering pool of narratives and of the people who come to find them. It is where we can glimpse immortality. In the library, we can live forever." If you are interested in being part of the Library Foundation and want to help make the library happen every day and for everyone, then let's talk. Give me a call at 949-717-3890 or find us online. Many of our community members are struggling with the challenges of the day right now, and people need libraries now more than ever. Your donation to the Newport Beach Public Library Foundation is the difference between a good library and a great one for generations to come.
There you go. Look, let me get back over here. You're up, Pete.
Patrick, come on up. And Patrick Chu is going to be our expert presenter. Why don't you, Pat?
Incidentally, since some of you may have come in a little bit later, I said at the beginning with everybody, use the question and answer. So at the bottom of your screen, if you move your mouse around or something, you'll see this little Q&A. Send us a note. I will monitor those. I'm going to disappear and let them talk. And that's what I'm going to do to be able to work through this. So bye. I'll be back.
Goodbye, Don.
Thanks,
Don. Let's see. Why don't you go ahead and put the presentation up, Patrick, share screen. And then one of the things is that we have a an hour and a half today. Last week we got confused a little bit on the time, and so we cut it off a little bit too short. So we're going to do an hour and a half today. One of the first things that the goal of this particular session, it's annuities and mutual funds, but it's the financial services industry is about selling products. And we're going to go through some of the products, but mainly going to focus on annuities and mutual funds, because these are the easiest to sell, and annuities on many occasions are the highest commission products that are out there. So other things that, you know, when you go into a bank, you're going into a store, and the store sells all sorts of stuff. Well, in this particular case, when you go into a branch or a bank, you're going there possibly loans, possibly to buy stocks, possibly to purchase options, a reverse mortgage, a regular mortgage, an interest loan, anything that they can do to establish as many possible relationships with you as possible. It's one of the things that Wells Fargo was caught a little red-handed when they started opening up bank accounts and people didn't even know that they were being opening up additional accounts. So it's all about selling your product. So how do you, as a consumer, figure out, are you dealing with a salesperson, or are you actually dealing with someone who is a professional advisor? So one of our presenters today is Michael Chu. Patrick, I called you Michael, Patrick Chu. So let's go to the next slide. And I think we got your Ask First form. And we're going to go through this in more detail than any other presenter. And a blank Ask First form was included as a handout in the first session. So if you go back to the first session, you should pick up and make a copy of that. And when anyone talks to you about their money or about your money, these are kind of the initial questions that you want to ask and discuss. So Patrick, I'm going to go through with you your education. What do you have your master's and other or another advanced degree in?
So I have a master's in business administration, and that was just the study of business and management, and that's from Cornell University.
And it says you have a CFP, which is a certified certified financial planner, and you also have a PFS. Where does a PFS come from?
Right. So the CFP you're probably more familiar with, and that's a certified financial planner. And then the PFS is a designation, personal financial specialist, that is only offered to CPAs, certified public accountants.
And what did you have to do to earn that?
So the difference is, I guess the first prerequisite is having a CPA license, but you have to do additional coursework. It's probably a little bit more in depth and definitely a little more tax focused.
So I'm going to stop you for a second. The CPA, you have to get a 4-year college degree. Is that correct?
Correct.
And then you have to take an exam, which is how long for being a CPA?
So the exam is a 4-part exam, and that typically covers, in the past, it was taken over 2 days, but you can spread it out now. And
Okay.
each test is 4 or 5 hours long.
Okay. And then the CFP is a 7-part program, 2-year program. And it's, I think today it was last year a 2-day exam. And I think that they've reduced it to a 1-day exam.
Right.
Is that correct? I'm not
Yeah,
100%
it's been
sure.
some time since I've taken it, but
Yeah.
I believe so.
Yeah. And then your PFS, did you also have to take a separate exam for it?
So there are different ways, and you can do it by experience and coursework if you already have a CPA and an additional designation, such as a CFP or a chartered financial analyst or whatnot. So,
Okay.
so yes, you do have to take an additional exam.
Okay. What do you think is most relevant? Your 18 years of experience or your credentials?
That's a good question. You know, a little bit of both. I would say the experience, and oftentimes when people put down that they have experience, you want to know what they had experience in. And so even though I spent some time on the financial planning world from a tax standpoint, that was very relevant to everything that we do. And so each piece, the CPA or the CFP or the PFS, has contributed to the overall experience.
Okay. Licensing, you are a certified public accountant and you have a license number and it's issued by the California Board of Accountancy. And are you an accountant today or are you a financial planner?
I am 100% a financial planner.
And how many years have you been in the business of financial planning with your own company?
We started our firm 8 years ago.
8 years ago. Okay. And approximately how much do you have under management today?
We have about $110 million that we manage for clients. And on top of that, we serve about 60 client families. And so, just talking a little bit about our firm is we provide a lot of financial planning and in-depth planning for our clients. And so that's why we don't have a lot of clients, because we get to spend a lot of attention on their situations.
Okay. But what I'd like to do now, Patrick, is I know you, and I think Donald's got one as well. We got invitations to go to the 5 Crowns for a workshop and or not a seminar or a presentation, and we get a free dinner. Could we turn to that ad?
Sure.
There it is. Go back. One more back. There it is. So you're a full-time financial advisor. This particular individual, David, is presenting as the at 5 Crowns. And he says he is a practicing attorney. He worked for Smith Barney and then Merrill Lynch as a financial advisor. And then he wanted to create a practice with finance, law, and tax. And below, he says he's an investment advisor representative, and he passed the Series 7, 24, 53, 63, and 65. That's pretty impressive. You don't have any of these. Why? Let's go back to yours.
Let's go back to that. There we go. I do not have any of those licenses or designations. And to go back to the Series 7 and the 24 and the 53, those are just exams.
One more. Let's go to the licenses and see what they mean.
And so these are all exams that you pass, and it really doesn't deem that you are necessarily qualified. It's more if you can compare it to, say, a driver's license or so. And it gives you the ability to sell products.
Yeah. So Series 7 is the most common one. So it allows you to, is there any kind of educational requirement in order to take the Series 7 exam?
Actually, for all of these series exams that we show here, there's no educational or experience requirement.
So you don't have to have a college degree. We were looking the other day to see whether or not you had to have a high school degree.
Right.
So you can advise people and sell them stuff and have zero education. Logically, I mean, you probably could if you're a good talker.
You could, and that's a little scary.
Yeah, yeah. But if you go back to his David slide, he makes it look like that those are designations. And, you know, he also has an insurance license. So in this particular case, I'm wondering what his business is. Is he in the business of selling product, or is he in the business of giving legal advice? I would, you know, we all have a B antenna and we all have an S antenna. And with this particular individual, I would be very, very concerned. So if we go back to the your ask first form, please. Not having any licenses from NASD or from the SEC or from FINRA is really a positive. And the only one that you'll find that most advisors such as yourself has is that the Series 65?
Right, it's the Series 65 or 66, and
that allows you to advise people.
Correct. It allows you to provide investment advice and get paid a fee. And there are, in our industry, if you have a CFA or a CFP, and there's a couple of other designations, you don't have to have a Series 66 or 65.
Yeah. And remember, a license is the minimum level of qualifications. You know, all of us have a driver's license. Very few of us are professional drivers. So I like that analogy, Patrick. So not seeing any licenses, you can't legally even sell any kind of a product to a client.
That's correct. We can only get paid for advice.
Okay. So you don't practice law. Explain us a little bit on the business relationship. What does that mean?
And that is... okay. So our business model is a registered investment advisor, and that's also known as an RIA. And that is different than what you typically see in our industry, and that's the broker dealer. The broker dealer is the wirehouse or so, for example, the Merrill Lynch's or the Wells Fargo's or whatnot. So a registered investment advisor, under that business structure, we have to abide, and we have a fiduciary duty to our clients.
And what does fiduciary mean?
And so fiduciary means at all times, we have to put the client's interests ahead of ours in all situations. And
as a broker, what is your duty to your client?
So as a broker, under the broker dealer model, they abide by a suitability standard, which is different than a fiduciary standard. And what that means is that an investment that they put a client in just has to be suitable for a client. Not necessarily the best option, but suitable.
Yes.
And
huge difference, by the way, between fiduciary and suitability.
And just to give a quick example, for let's say a client wants an S&P 500 or a US large company mutual fund. The broker dealer might have their own proprietary fund that they can sell to a client. And there might be other funds out there with the exact same holdings at a tenth of the cost, but both are suitable for a client. And so the broker dealer could put you in their fund because they get paid more. Whereas in our scenario, a registered investment advisor, we have to pick the one that's best for you.
Right. And is there a law that says that a broker can't call themselves a financial advisor?
You know, they are working on that, but right now,
You can call yourself anything you want,
everybody
right?
can call themselves a financial advisor.
Yeah.
Correct.
We're going to give a degree out for all those participants who spend all 8 weeks with us, and we're going to call you the wealth specialist. We'll give you a nice certificate, and we'll send and put it on the wall. You probably, you know, this is hard to believe, but if you spend all 8 weeks with us, you have probably spent more time studying this area than most brokers. Patrick, we were out together one day, and you were telling me about your internship at Merrill Lynch. You know, when you start an internship, usually you think of, you know, you begin to learn the trade about financial planning and investing. What did they have you do in the first couple of weeks?
Yeah, well, that was quite some time ago, but the internship, I think that was my first exposure to our industry. And basically on day 1 or 2, you're handed a phone book and asked to make cold calls.
Yeah.
Without knowing anything.
Yeah, it's still that true today. They don't care what the degrees only come in to help. People love designations. So please understand the difference between a credential and a license. A license is not a credential. And so there's many individuals who have credentials who go into this area of insurance and finance because there's so much more money can be made. That's why an individual like David is, you know, I have real doubts. I've never met the man. I don't know. I looked him up on the internet, by the way, and his office, his law office is in Oakland. I wonder, what is he doing down here, giving a workshop? And then, you know, so we'll get to that in just a little bit.
Pete,
but
Pete,
how are you paid,
Pete,
Patrick?
Pete,
Yes.
we have a question. We have a couple of questions. So on a registered investment advisor, I'm assuming you, Patrick, you have to be affiliated with some broker dealer because you can't buy or sell stocks. So what firm do you work with to implement your trades?
So that's a good question. And I guess affiliated is a little bit different. So with an RIA, a registered investment advisor, we custody client assets at different firms. So for example, the role of the custodian is to safeguard client assets. So we custody client assets with Schwab and TD Ameritrade. And that means that when a client works with us, we advise and we can trade on the account, but they have their account held at Schwab or TD Ameritrade. And that really protects the clients. You know, for example, the Bernie Madoff situation can't happen. If you decide as a client to fire us, you still have your Schwab or TD Ameritrade account, and we get cut off. We aren't able to do anything with that account. There are firms that are affiliated with broker dealers, like a wirehouse, and that's because they're trading and selling products, and they need to access those products.
So you're completely independent, and you have what's called a limited power of attorney over your clients' accounts.
Correct.
Okay.
Okay, and then there've been numerous questions we've had along the way of a fiduciary. One, I'd like you to define that in a moment. But the other part of it, is there a certificate that says I'm a fiduciary? How do I know that someone is a fiduciary other than using the Ask First form?
So that's a good question. I was actually on a panel with a member with a gentleman who worked at one of the wirehouses, and somebody asked a similar question. And I think you have to ask if they have fiduciary duty. I think, you know, in addition to the form, I think just asking. Number two, if you look at some of the licenses, for example, the CPA or the CFP designation, that by itself, they have their own fiduciary obligations. But where the term gets a little confusing is on that panel, they asked if we had fiduciary duty for our clients. I said yes, and the gentleman from the wirehouse said, we take a fiduciary approach to our clients.
Ooh.
So it's you have to pay attention to that. But
Patrick, I'm going to interrupt you for a second. What is every client such as every financial advisor such as yourself have to give your client the ADV form? What is it? And in there, it would state whether or not you are a fiduciary.
Right. And so the ADV form is something that we're required by the SEC to provide clients, and it describes our business, and it talks about us being a fiduciary and having that obligation to our clients.
Yeah. And how you're paid, where your money comes from.
Right.
It's full disclosure. It's kind of like the prospectus is for investments. And we're going to talk a little bit more about how do you find out independently as well. We'll get there in just a second. Let's get back to how are you paid? Who pays you? Patrick?
So in the registered investment advisor model, the fee only model, only the client pays the firm.
And you charge on an average of 1% or less?
Correct.
On the investable assets.
Correct. And so we're not paid, but for products, it's just on the advice.
And you're paid on a quarterly basis. Is that how you pay yourself?
Yeah, and firms can charge differently. We charge quarterly.
Okay. That's one of the first things that you ought to be talking about is how is a person paid, because that gets us back to being a fiduciary as well. If somebody says they're on commission, they're not a fiduciary, as far as I'm concerned. If you wanted more information on the fees, but let me go a little bit different. Let's say I invest $100,000 with you, Patrick, and 30 days later, I just don't like you. What do I do?
Well, you just fire us, and you can give it to us in writing. But what happens is that, as I stated, we're detached from having that power of attorney on your account, and now you have your $100,000. Hopefully, it's a little bit more than the $100,000 at that time, but you have that account, and it's yours.
So, no losses unless there was any kind of investment loss.
Right.
Okay. Let's turn it different to the wirehouse, to the broker. You're now the broker. I give you $100,000 and you invested with American Funds. American Funds charges like 5.75. I'm going to say 6%. First of all, how much actually gets invested?
So if you're giving the same $100,000 and 6%, we'll say $6,000 comes right off the top.
So actually $94,000 get invested.
Correct.
And now 30 days later, I want to fire the broker. Do I get my 100,000 back?
You get back the $94,000.
You lost $6,000. Okay. Let's go back to the your ask first form. Are you affiliated with anyone who sells annuities, mutual funds, or financial products?
We are not. And that was kind of the question I was getting at, I think, with the terminology is we're not affiliated with any particular broker dealer.
Okay. And so if somebody needs to purchase insurance, and because insurance is very important, what do you do?
So we'll help run the analysis. We can also work with some of our fee-only partners. And then when we find out what type of insurance or so that the client needs, and we go and we can shop it around, and we look for independent third parties who's going to give them the best product for the best price. And we'll introduce them or connect them with that company. We do not receive a commission for that.
And you don't receive a referral fee or anything else like of that sort.
Correct. And oftentimes what we'll find out is we help the client understand which policy makes sense for them. And their best pricing is through their existing carrier, whoever already has their homeowners or their auto, because they get an additional discount there.
Okay. Let's go back to David. Okay, here David has, let's go back to the fine print of his brochure. Go down to the small print down below. Okay, Yeah. Okay. Now, Patrick, explain to us, what is the investment advisor offered through Liberty Wealth Management, LLC? What does that mean?
So that's the company that he's working for, in a sense that is a registered investment advisor, and he's offering the investment advice, and so he can charge the fee through that company.
Okay. Then he says securities offered through AE Financial Services, member of FINRA SIPC. What does that mean?
And so that's where it comes in, where under the model, there are some RIAs that, and Pete, I think we'll go through this, that are fee-based. So they wear two hats. They can both charge and provide financial advice, but they can also sell you products. And so he is selling products through AE Financial Services, and that's the broker dealer.
Yeah. So he doesn't sell it as him as an individual. He has AE Financial Services sell that. That's his broker dealer, in other words.
Correct.
And then he also sells insurance. And the law is on insurance is anytime you put an ad in California, which this is what this is that you have to have your insurance license number listed. And so he's following it, but it doesn't, again, put it through his own name. It's through a separate lifetime planning marketing. So what, if we go back through to his bio, Patrick? Okay. So Dave is on a mission to reduce his clients' financial by addressing their biggest challenge and future goals. He's created a vision, a firm, so he can practice in finance, law, and taxes under one roof. So bottom line is he wants revenue from you when you sell an insurance product, when you buy in securities, and if you're going to do anything having to do with an estate plan. I would use extreme caution. And somebody who has been in the media, he's selling every which way possible. Now, if you want to do a free dinner, it's local, Crown, 5 crowns is kind of nice, and they offer a virtual seminar as well. But you have to have an appointment in order to get the $50 for the free dinner. Okay. We hopefully we beat this into the ground, that stay away from these folks. Okay. It's just not a good idea. Patrick, you have your bio. I'm going to let people go through that on their own.
Right.
And we talked about the licenses. Let's go to picking out a professional advisor slide. Oh, go back one. People asked, what does FINRA stand for? It stands for the Financial Industry Regulatory Authority. One of the biggest things that FINRA does is a program called Broker Check. And we hand out an entire article on the materials page, how to use Broker Check. So anyone who presents for us, or anytime I meet with a financial advisor, the first thing I do is go through Broker Check. It evaluates both individuals and firms. So companies like Merrill Lynch, UBS, they have, 20, 30, 40, 50 pages of disciplinary actions taken against them. Okay. And you need to know that before you choose someone in the finance. If they have FINRA on their business card, then you know they are a broker. Okay. If they're just covered by the Securities and Exchange Commission, the SEC, then you have a registered investment advisor who is not selling product. Okay, let's go to The next
Pete,
slide.
Pete, wait a minute,
Yes.
Pete. You've actually just touched on a question that we had. So given a, I'll use Patrick, you're my example. So you recommend that someone buys a mutual fund or buys a sum fund or something else. Do they have to go to Schwab to buy it, or do you handle that transaction for them?
So we would manage the investments and handle it for them.
Okay, so that's simply a part of what you do, is handling that, of this is what we recommend you do, and we will implement that for you.
Right.
And there's
And so, Don, our core service is our firm, and it's not too, it's pretty common in our industry where we've separated out. We've got the financial planning is one core service, and then we've got the investment management. So the planning might cover investment planning and helping them figure out what investment portfolio or allocation makes sense to them. The investment management is the actual implementation. So that's where we would have what Pete talked about earlier, the limited power of attorney to make trades in the client's account and debit agreed upon fees. And that's all we can do.
Yeah, usually the Schwab TD Ameritrade, it's like $10 per trade. So it's nominal, but Patrick or the fee only advisor doesn't get any part of that.
Okay, so then a registered investment advisor may or may not be a fiduciary. You don't know that. That happens to be your business model of performing as a fiduciary.
So a registered investment advisor by itself is supposed to be a fiduciary. And then within that, there are two different types of registered investment advisors. There's the fee only, which only charges clients for advice. And that's our model. And that's the least amount of conflicts of interest you can have in our industry.
Let's go to the next slide. I think we
Okay.
can explain it a little better.
Yeah.
So we say using a professional, do the ask first form, education, experience, compensation, references, recommendation based on needs, not commission driven. I think we understand what fee only is. Go into a little bit more detail on what is fee based.
Right. And so, Don, RIA by itself means you should have a fiduciary obligation and fiduciary duty to the clients. But there are some firms that are fee based, and we see that here. And that means they can charge you one of two ways. They can charge for the advice, for the fees, for the investment advice, and they can sell you products and receive commissions. And so that's where it starts to get confusing, and the ask first form helps in understanding how they get paid. But also just understanding how the business is structured. So for example, Pete, the example used of the gentleman before, he works for a fee-based RIA.
Yeah, and he does his securities through a separate group.
Right.
So fee-based, he can charge fees for whatever, and then get commission on the insurance products, on the mutual funds that he sells, as far as his recommendations of his plan. So from my point of view, when you see fee-based, run for the hills.
And it doesn't mean that they're a bad advisor, but I think what happens is it gets confusing. Like, which hat are you wearing when you're talking to a client? Am I doing the fee only hat, or am I telling them to go to this product because this one's going to pay me a better commission?
Yeah. How do you know? And then there's commission only, which I think is pretty much understandable. By the way, insurance is the highest commission products out there. Let's go to the presentation. Annuities. Wow. Our annuities used to be the most popular investment back in the 50s, 60s, and 70s. And then mutual funds came around and took a lot of the insurance annuity products decline. But Patrick, how big is the annuity market today? Approximately.
So the only reason I know this is that we recently looked it up, but it's last year they had a 12-year high, and there's $242 billion in annuity sales.
Wow. And commissions on annuities range anywhere from 3% all the way up to 35%. I've seen them that high when I was at Long Beach State University. So what are they? They're literally a contractual relationship where one party agrees to pay a sum of money in exchange for a payment for a period of years or for life. And we'll get into that. That's called annuitization. One of the main things to remember on this is that annuities are not subject to securities and exchange rules. They're probably, the insurance industry is probably the most powerful industry here in the United States. And it's the only, I consider it an annuity and investment, but they're not subject to it. So if you want to have a complaint, you have to go by, each state has its own commissioner as to controlling that particular insurance company. So where do you think most of the insurance companies are located? Iowa, where they're least regulated. So, and their contracts. And these contracts are so convoluted that normal people, normal attorneys cannot understand them. And that's why they give you a 30-day right to rescind. The only other contract in the financial service industry, I know of anywhere, is the timeshare sales pitch, you know, where they really pressure you as to purchasing a timeshare. And that's 3 days. Here, you got 30 days. So no matter what the insurance agent tells you, there's a clause in that insurance contract that says, doesn't matter what the insurance person tells you, we'll only look what they call it the four corners of this contract to see what your rights are under the contract. Earnings inside the annuity are tax-free. So maybe for a really high net worth individual who needs to shelter more income, it may be appropriate. But the problem is the payouts are taxed at ordinary income tax rates. So from 15 to 20%, you could be paying 30 to 37%. So what is your real rate of return? Okay. Qualified and non-qualified annuities, we're not going to go into that. Let's go into the next slide. There's deferred annuities, and the deferred annuities are kind of like the savings. Many school teachers have these. They pay into them in their 403B, and as sometime in the future, they take the money out. And then there's the immediate annuities. Immediate annuities are becoming quite popular today because of the fact that they pay a little bit more than usually your bank rates. Now, in your material online, I gave you a sample annuity advertisement, and they advertise in there from 8 to 12% annual return. And that in annuity lingo is what's called a fixed rate. Can we go back to that?
Sorry about that, Pete.
No problem. Fixed in insurance lingo means that the rate is fixed for 6 months to 2 years. It doesn't mean fixed in your own mind that, you know, hey, this is what I'm going to get until I die, or so long as I have the annuity contract. There's also what's called a guarantee. There's a couple of guarantees within an annuity. One is that the annuity, the company, the insurance company itself, you know, you got to look at their finances. And, you know, there's rating agencies out there. Who pays these rating agencies, Patrick, when they rate these insurance companies?
The companies themselves will pay.
Yeah, it's a little conflict of interest, you know. But anyway, they have a multiple level different. What you want is there's no reason to go below the top rate if you're going to get a fixed annuity. It used to be that the government had to guarantee a minimum rate that they had to pay out of 3%. So if you have an old annuity contract, you want to make sure it might be still subject to 3%. You know, 10 years ago, 3% was nothing. Today, somebody's going to give you 3% on your money. It's almost like gold. So never assume what you have is bad until you really take a look at it. The laws.
Pete?
Yes.
Pete, there's a question in terms of an annuity. If you already have an annuity, how do you decide when to start collecting it?
Good question. And we're going to get there just a little bit because it's not an easy answer.
Okay, and well, I've got your attention. Patrick, a question for you since we skipped over, thank heavens we skipped over the bottom of the Ask First form. We'd spend a lot of time there. What do you charge?
Oh, that's a good question. So we post our fees on our website. So financial planning is hourly, and that depends whether it's administrative. We have staff or analysts working on it, or if one of the partners is working on it.
So what's your average hourly rate, Patrick?
So the average hourly usually on a project is probably going to be around $250 an hour.
And what is the range of a cost for a total financial plan?
You know, we don't do a lot of basic financial plans, but the range would probably be, I'd say $2,000 to start from scratch to make a plan. And then if we were charging and we were doing the investment management, that's where our fee schedule is posted. And we start at charging a % on the first $2 million.
So your minimum is 2 million? Your minimum is 2 million?
You know, we have a stated minimum of $2 million.
Okay.
And so I'll get into that. And that's another question you want to ask the advisors. We do have clients that we work with that aren't at that minimum. But the reason we've set it there is because we really like to get into the weeds on the technical aspects of somebody's plans and not just the investments. And so at that level, we don't charge two separate fees. We're just charging one wealth management fee, and it includes the investment management as well as the tax planning, investment planning, retirement planning, and looking at all of that stuff as well.
Yeah, just to give you an example, most fee-only advisors will charge 1% or less, and but the average client with a broker pays 3% per year. That's on average. But the fees are so hidden that it's hard to figure out what you're actually paying. For example, in the annuity, you're not going to know where is the fee. Well, we'll tell you just a little bit where the fee is and how you can figure it out. Let's go.
Pete, one more note on that. So we'll get into it with the mutual funds as well, but when you're looking for an advisor, there's the advice fee that you're going to pay. And then you want to look at products have underlying expenses, and you want to understand what you're actually paying for. The same thing for the services. If you pay 1% to our firm or 1% to another firm or another firm, what are you getting for that 1%? And you want to make sure you're getting value back. And that's where, you know, we like complexity. Like we like to really work on some of those complex projects. You know, you might go somewhere else because you don't need that. You don't have that complexity to your situation, and you might be able to find what you need for a lower rate too.
Let's go to the next slide. Okay, so types of payouts, you have an introductory and fixed rate, which changes. The typical immediate annuity rate is somewhere around the 1 year treasury rate. So annuities paying somewhere right around 2% today. The guarantee rate, we talked a little bit about, that's substantially lower. If you call up an annuity company and say, hey, I would like to withdraw my money, there's a withdrawal rate as well. There's one other charge on there that I don't see listed, and I forgot to include it. And it's called the surrender charge. Okay. The surrender charge means that if you purchase this annuity from a sales individual, that salesperson needs to be paid. And after 30 days, your contract is locked in. So after 30 days, that salesman gets paid. The surrender charge, if you pull out, and they usually have somewhere between a 5 to a 7 year surrender charge period, where you start out at 7 1 year, and then it goes to 6, and then goes to 5, 4, 3, 2, 1. And so that's the surrender charge. You can kind of figure out what the insurance salesman is making when they sell you an annuity. It is not free. Let's go to the next slide. I'm going to cover variable annuities after we get done with the mutual funds. So let's go to the next slide.
Pete, I want to stop you for just a minute. I have a couple comments on annuities. One of them is, in a flexible universal life insurance, is the investment component considered to be an annuity, and do you recommend that?
Patrick, do you want to answer that, or do you want me to? Either way.
You know what? Why don't you take that one?
Okay. These universal policies. You're much better off investing that money in with a no-load mutual fund, which we're going to talk about. There are so many fees within these annuities that you just aren't aware of. So I would decline one of those kinds of products. And if you have one, meet with a fee-only fiduciary advisor to go through it. And by the way, Patrick, do you guys give a free hour and a half to anyone who wants to come in and talk to you?
We do, and well, I guess right now it would be via Zoom, but no, I think people reach out to us, and we're always willing to take the time to find out, learn about their situation. We don't charge for that. Yeah. And, you know, oftentimes they're a fit, and then sometimes they're not. And we try our best to help find them, to point them in the right direction. Yeah.
And some of these products are very, very complicated. Another thing about annuities, there's a thing called a 1035 exchange. What is a 1035 exchange, Patrick?
Yeah, and before we get to that, I just wanted to comment on the insurance policy question, so that the funds within the insurance policy are not considered an annuity.
Thank you, Patrick. I forgot to answer that.
But the 1035 exchange, we see this a lot. So when we deal with annuities, and the interesting thing is some of the carriers are now developing annuities for fee-only registered investment advisors.
That's fairly new, isn't it?
Correct. And it's a recent product. And what it is you've got lower expenses. So you've got a lot of index funds available in there. You've got lower administrative expenses, and they pay zero commissions. Some of them even have zero surrender charges. And so that doesn't benefit, you know, us directly in any way, but it's a way we use that 1035 exchange to rescue clients from their annuities. And so the 1035 exchange allows you to get out of an old annuity, or an annuity that might be unfavorable, to a more favorable annuity. And some of the reasons might be, you know, the payout feature, or the expenses are significantly less or so. And it's a tax-free exchange. So you don't have to pay any taxes when you're making that exchange. But one of the biggest things you want to pay attention to, though, is making sure that your existing annuity is not subject to any surrender charges.
Yes.
Because if you do that, you're going to pay a lot in charges and fees to move it over to another annuity.
Yeah.
So Pete, that really fits in a sense probably to one of the questions we've got. I have a 15-year-old annuity from my dad's death, which pays 3%. Are any fees still being charged?
The good news there is that the fees are internal to the product, and the 3% is, because it's an old annuity, is a guaranteed rate. So the problem in answering a question on first blush, I would say that's a keeper. Where can you get 3% instantaneously on a regular basis if the insurance company that has issued that annuity is solid? So it's hard to generalize, but just on first blush, I would say that's a keeper.
Yeah, and sometimes, as much as we don't necessarily like to use a lot of annuities, sometimes the annuity that the client is in is the best situation they can be in there, and it doesn't make sense to do an exchange or so.
Yeah, it's all about, these things aren't, it's hard to generalize. And that's why I kind of frown on Susie Orman or any other marketer out there that gives these general platitudes about what is best. They don't know your client, your situation. They don't know what else you have. It's hard. It's kind of like going to a medical doctor and you go, okay, I'm going to give you my blood pressure, but I'm not going to let you do any my blood test. You got to have the full story in order to help somebody. And so I would encourage you, I would not sell that annuity until I saw somebody as a fee-only advisor and to take a look at it.
Because to your point, we're giving information and knowledge. We are not recommending any changes or doing anything else.
We're the no change workshop, okay? Because every time you make a change, it's either going to cost you money or it's going to cost you in taxes. So you make changes very slowly, and you understand, most people don't understand what they're presently paying and what you're going to be paying. So cost is what we can control. We can't control performance. We're going to get back to indexed annuities, but indexed annuities are the hottest product right now. And they're the ones that are being given at most of these free dinner seminars. So be especially careful, and we'll get back to indexed annuities a little bit later. Let's go through the next slide, Patrick.
I did. I went ahead of you.
Okay, go ahead. Let's go to the next one. Okay. We're going to go back to variable annuities and indexed annuities once we understand a little bit more about mutual funds. Mutual funds is really a simple vehicle. It's literally just money's pooled together, and there's a fund manager. So, and the fund manager gets paid for making the investments. So what would a fund manager or an investment manager for a mutual fund that is involved in stocks, what would be a good, fair payment to them, Patrick?
Well, depending on the strategy, something less than 1%.
Okay. And bond funds, what should we pay to fund manager?
Probably something half of that or less.
Okay.
So less than half.
And the reason for that is because bonds are just don't give you the kind of income that stock funds do.
Right. There's lower expected return, so you shouldn't have to pay a higher fee on that.
Okay. International funds. What would we pay to fund manager?
So international stock funds would be slightly more, and part of that is just the research involved. It's just it requires a lot more research. Emerging markets is for really small countries typically, and those are typically some of the most expensive funds. So
the fund manager, we would pay them approximately what, 1.5?
Yeah, so I'd say add 0.5% on there.
Okay.
So,
okay. What is a basis point?
A basis point is a fraction of a percent.
Yeah. So in
So-
financial markets, they always talk basis points. So how many basis points are in 1%?
100.
100. So if we talk about stock funds, we'll talk about 150 basis points, bond funds, 50 basis points, international funds, 150 basis points.
Yes, and that's what we talked about earlier. I had mentioned to pay attention not only to the fee that you're paying an advisor, but the fee that the underlying fees of the products. And I think we'll go into that a little bit more here.
Okay, let's go to the next slide. Okay, so if we just went into a fund and the only expense that we're paying is for the investment fund manager, we invested in what's called a no-load fund. So no-load funds are sold directly to the public and they do not pay any commissions. Okay, of the no-load funds versus load funds, there's 18,000 plus mutual funds out there. Half of them are no load, half of them are load. Is there any difference as far as quality is concerned, as far as investment advice between a no load and a load fund? If all we knew about it is whether it was load or no load?
No, absolutely not. In fact, there's a lot of funds where it's the exact same strategy, same holdings, but they just develop different share classes to I guess, try to appeal to different segments and sell them under different ways.
Okay, so the vast majority of mutual funds that are sold today are loaded funds. And so how do you tell whether or not you purchased a loaded fund or a no loaded fund? Well, one of the things is that there's usually an alphabet letter called share A, share B, share C. Sometimes a mutual fund company has 20 different letters describing their class or share. What is a class A? Patrick?
So a class A is a fund that you would buy and it's sold because they're trying to sell it to somebody who has a longer time horizon. So they say it's front loaded. So you pay a bigger commission up front, but it's got lower expenses on an annual basis. So if you hold it a long time, they'll tell you that you'll be better off that way.
Yeah. So American funds, for example, most of their funds are at the stock funds anyway, are at the 5.75%. And American funds has billions of dollars under management and offer a variety of different class shares. What is a B share?
So a B share is something where the commission is paid on the back end when you try to sell out of the fund. And because there's no front load, it'll typically have higher expenses.
Yeah, I called the NC, I call that the continuing load. So how do, when you're dealing with a broker, how do they figure out what class of share to put you in?
It really depends how they want to get paid and maybe how long they think they're going to stay with the firm.
Yeah, it's all about them. Yeah, I had a guy, he says, well, the client came to him in September and he already did his quota for the year to get his bonus as far as trips were concerned. And, this is a sales operation. And so he put the client in a class B share, back-ended loaded, because he didn't need the money for another 3 to 4 years. And the client was going to pay higher expenses on an annual basis. And class C shares are many times sold as the no fee, the fee-based. Hey, we're not getting any commissions. Just that all your other expenses are absolutely abnormal. So the only way you can really tell what a class A, class B, class C, class D, class F, class H, what they are by looking at the prospectus. Or with Google, it makes it a little easier. You have your mutual fund, put the name of the mutual fund in there, put in the class that you have, and then Google will help you figure out what your cost is. It's one of the most important things that you got to know is what you are paying on an annual basis. Let's go to the next slide. Well, it's not bad enough that on most of your loaded funds that you have a commission to pay, and that commission is once you pay that commission is gone, and that money does not get invested. On an annual basis, you have what's called 12B1 fees. What are 12B1 fees, Patrick?
In 12B1 fees, you'll find that in the funds that typically have higher expenses. And that's because that's a distribution and marketing expense that's passed on to the consumer. And it's the fee that they charge for marketing and selling and advertising the fund.
And how does that benefit the client?
Well, it really doesn't. And so you won't really see these with some of the lower cost index funds.
But many of your load funds have 12B1 fees in there because the broker dealer gets usually a part of these funds.
That's correct.
You know, so be careful. Other expenses, what does that mean?
No, I think that's just administrative expenses and whatnot that are also passed on.
And that's 25 basis to 75 basis points a year.
Right.
So American funds, I mean, these are multi-billion. To get 25 basis or 50 basis points per year from every single client's account just adds up to huge money. So if you're going to look at a mutual fund, go to no load. Schwab has them. TD Ameritrade has them. Go to Vanguard. They're not going to have any mutual funds with either 12B1 fees or other expenses, and all of them are no load. And that's with Vanguard. Schwab, Fidelity, they may have some loaded funds, so just be careful there.
Yeah, and there's really no reason to use a loaded fund because I think with the no load funds, not only do you not pay that commission, but you have more flexibility. For example, with the A shares, if you buy the fund with 6% commission, what if you change your mind next month or so, or you need the money for something, a medical emergency, you pull it out and you've already lost that 6%.
Yeah, and so you use primarily index funds and no load funds in your practice, Patrick?
Well, none of our funds have loads. And even if they did, I guess technically we couldn't collect the commissions. But no, we use no load and very low cost funds, passive based.
Okay, let's go to the next slide. When you decide on a mutual fund, you have to understand expenses. Where can you find out this information? What do you use in your practice for getting information on a mutual fund?
So we've got a variety of resources. I think in quick and credible sources for just the general public looking on the internet. Yahoo Finance and Morningstar be great starting points, and you've listed quite a few others over here. You don't have to read the prospectus because that's going to be 100 pages and 10 hours of your time that you won't get back. Yeah. But if you want a quick summary, that's where Morningstar and Yahoo Finance and Lipper and some of these other resources, you can see performance, you can see all the fees you'll pay, the different share classes, et cetera.
Yeah, one of the nice things too, I'm going to give a plug to Meg and Newport Beach Library Foundation, is that they purchase Morningstar, Lipper, Value Line, and you can go into their library, use them all for free. And it really kind of breaks down in everyday English as to what the mutual fund is about. And it compares different mutual funds to other mutual funds of like kind. So, and we'll talk more about that in the equity and then the bond session as to picking mutual funds. And so I don't want to spend too much time on that. But this is, I think, one of the more important things. What is an active and a passive mutual fund? Or sometimes managers such as you are either called an active manager or a passive manager. What does that mean?
Right. And I know you'll go a little bit more in depth into this in the equity section, but from a high level, this relates more to the stock investing in the stock funds. And active, when you hear that, that's more your traditional or conventional way of managing. And that's where you've got these fund managers that are trying to find deals. They're trying to identify, mispricing in stocks, and they're trying to forecast and stock pick and time the market. Typically, the active funds will have less holdings, so they might have only 50 to 150 companies in that mutual fund. But because they're doing a lot of active trading and they're trading daily, that generates higher expenses and trading costs as well as taxes. So the higher expense or the more expensive funds are going to be active typically. Now, passive is, we'll call it the new way, and that's kind of indexed management. And that's where, for example, rather than saying, I'd like to try and pick 20 companies that I think are going to outperform the whole stock market, how would I just take the stock market? And so, for example, an S&P 500 index fund would just take the largest 500 companies in the US, and you would buy a fund and it would just be invested in that. And, you're attempting more so to match the performance.
What would a fund like that cost, by the way, compared to, we know kind of what an active fund would charge. What would a S&P index fund charge?
Yeah, so with the S&P index fund, you're probably looking at 10 basis points, 0.1%, versus 1% on the active front. And that's why it's virtually impossible to consistently beat the market for these active fund managers, is because not only do with their 50 stocks or their 50 companies have to beat the market, they're also charging almost 1% higher than the passive fund. So it's very difficult for them to beat their benchmark on a consistent basis.
Yeah, and most individuals believe that the reason why they want to go to a financial advisor is to pick the best fund. Is that feasible to do on an annual basis, consistently, year after year?
No, we're passive based. You can't beat the market. And, if you try it, we've got charts, and there's charts you'll probably see in the equity section, but you think that the US is doing well, so you invest there, and the next year it's the worst performing asset class. So you don't want to get into the game of trying to stock pick.
Yeah, some people call it evidence-based investing, but there is no study out there that shows that any single individual or manager group can consistently outperform the market. So you might as well just be the market, and that's what a passive index fund is. Is that correct?
Right.
Okay. And then we didn't have this on the chart, but exchange traded funds, ETFs. What are those?
So mutual funds are a collection or a basket of stocks that we talked about, or bonds, and their price is determined at the end of the day at the close of the market. ETFs, or exchange traded funds, are traded more like stocks. So you will have funds with different strategies, but you can buy and sell them throughout the day, and their price will fluctuate throughout the day as well.
Okay, we'll talk more about that, but we want to get that in under the passive. Let's go back to the variable annuity slide.
Okay.
And I'm going to talk while you find that. When we used to be that you used to have you go to work for a company, you work for them for 30 years, you get a pension, or you get an annuity literally for life. And basically that's what Social Security is as well. And so insurance companies starting to lose business to mutual funds because people were developing 401ks and investing their money into a mutual fund and not into an insurance product. So they came up with a concept called a variable annuity. And a variable annuity is exactly the same thing as a fixed annuity. It's a contract. But what variable means is that your income is going to vary based on the performance of mutual funds inside that contract. So let's say Patrick owned Fidelity Funds and I owned an insurance company. So I would go to Patrick and say, Patrick, I want 5 of your mutual funds and to put into my variable annuity. Well, Patrick is not going to give them to me for free. He's going to sell them for my use. So I'd have to pay for them. Now I can determine in the variable annuity package as to what to charge. Now, every single time there's a mutual fund sale, brokers are obligated to give you a prospectus. Well, can you imagine a variable annuity? You have 5 mutual funds, so you got 5 prospectus, plus on top of that, you got an annuity contract. Nobody understands them. Forbes magazine on the front cover and back in the 1970s called variable annuities legally stealing because nobody understood them. And they're sold to people who are unaware. So people are becoming a little bit more about variable annuities, but they're very expensive. Let's go to the next slide. So the product today is called indexed annuities. So instead of picking out 5 active management funds, they pick out a choice of index funds that you could choose inside the annuity wrapper. And the annuity wrapper is considered considered a fixed income investment. And you don't even have to have a securities license to sell an indexed annuity. And these have anywhere between 5 to 35% commissions. Most of them are about 15%. They're so convoluted, PhDs in math can't figure these out, but they have a promise, and the promise is right in the middle. They're often sold with the promise of market-like returns with no downside. You don't get the upside in the market, but if the market goes down, you do not lose any of your principal, the amount you put in. And there's human nature is investors tend to hate losses about 2.5 times more than we enjoy equivalent gains. And we'll just about do anything to avoid losses. So indexed annuities today are going through the roof because people just love the idea that they're not going to be able to lose any money. Stay away from indexed annuities. The average return on indexed annuities, if you keep them for the length of your life, is approximately 3%. There's much better choices out there, and it's illiquid because usually your surrender charge period is also equivalent to the percentage. So I've seen them as long as 15 years where you're going to pay a surrender charge if you want to get out. Anyway, that almost brings us to our time. Don, do we have any more questions?
There have been a couple along the way. We've basically covered them. One was related, ironically, to this slide you have up now. And there was, I guess on one of the slides saying there was an insured return. I don't believe that means literally insured. I mean, they are saying we're going to do this, but it's their return that they're going to have for you. There is no real insurance in these types of annuities. Now, I'm going to say in week 5 of the It's Your Estate program, where we talk about charitable giving, I'm going to talk about a charitable gift annuity, which is very different than this. That is a locked-in amount and is far different than a commercial annuity. So Pete will talk a lot about, he's not really in favor of annuities. And I always wave a little flag and say, you're not in favor of commercial annuities. You like charitable gift annuities.
Charitable gift annuities are a fixed a percentage. There's no commissions involved. And you'll find that most professionals, other than individuals such as Patrick, would even recommend a charitable gift annuity because they would lose that money under management and they don't receive a commission. So charitable gift annuities is a wonderful comparison if you do want an annuity and make a gift. And Don, you're going to do that presentation with David, correct?
Yes, David Moore.
Week 5 under the It's Your Estate, I believe.
We'll be doing that on the 21st of October.
Good.
And Patrick, why don't you stop sharing? That way they can look at the three of us in big form. There you go. So basically, we've covered most of the other ones. One thing, it's a couple of notes here. Yes, last week I forgot to confess at the beginning. I am married to a Catholic, so I understand confession complexes. I messed up last week and ended us at 2:30 instead of 3. I'm comforted in that one of you thought was confused because you thought we finished at 2. Well, I dragged it out until 2:30, but missed the rest of it. The good news was Pete has put on the website the answers for the quiz. So we went through all of them and told you, but that way the answers are there and a lot of them had explanations as to what was going on. So that's there. Secondly, the material, someone had said they got in a little bit late. The material is available on the website. The website is on the reminder you got an hour before this session. So whatever you clicked on to get in here, at the bottom of it, it says material at It's Your Estate and money. I'm sorry, It's Your Money at Estate.org. So that's where you go to get the handout material. That's where the video will be placed. So if you missed the beginning of it or want to fast forward through Pete's discussion of the information, that's where that will be. Do you post the presentation from today on the website? Yep, as I just said, the videos from week 1 are already posted for It's Your Money and Your Estate. The presentation that we're doing right now, since I have not messed up and not recorded it, that is running right now. That will be there within a couple of days. It will be available for you to take a look at.
Yeah, and if you have a question, Patrick has his email address on the last slide and also on his Ask First form. I have my Ask First form in week 1, and you're free to give me or Dawn some questions. The whole idea of the program is for you to get an understanding of the financial services industry. It's predatory, and we don't want you to be a victim. You know, you don't want you to get scammed. And even if you don't, at this particular point in time, want to use a fee-only advisor, maybe when you're 85 and 90, you may want to consider one. Or when your first spouse dies, or, you know, for some time in the future.
My first spouse?
Well,
how many am I going to have, Pete? I'm going to keep the one I've got. She's great.
Let's see. You're a Catholic, so what do we say?
She is. I'm not. We're a mixed marriage. That's a whole nother thing. And I want to reiterate something that Pete said along the way. We are not the, here, go to this seminar and now sell everything you own.
Yeah.
Don't sell anything. Have a plan. Know what you're going to do. Think about it and talk to someone, because I don't know your specific situation. Patrick doesn't. Pete knows everything, but not your specific financial information. So it's important to talk to a preferably fee-only advisor and go through and have a plan. You will learn a lot, And several of you have taken Pete up on his offer to send you a certificate at the end of this class, which I found fascinating. It's now on the video, so you have a record of it. Thank you very much for being here. That's the end of week 2. We will
Thank
see
you, Patrick. Thank you, Don.
We'll see you tomorrow if you're going to do estate. Otherwise, we will see you next week. And Laura Tarbaugh will start talking about financial planning and get into more of the details. So I thank you very much. Been a pleasure. We'll talk again.